Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Friday, November 18th, 2022. It's 12:29 p.m. as I'm starting the video, and there's not a whole lot of new developments to report, but I'm just going to go over well, just what I'm doing, what I'm seeing out there right now. As of course, as we head into the weekend, remember it is a weekend coming up, so swing traders are going to have that overnight risk. Even if you trade futures, they're going to shut down today at the end of the day and not pick up till Sunday evening. So let me just tell you what the things I'm watching kind of near term, what I'm doing, and then bigger picture stuff. Crypto to me is probably one of the most important things to watch right now, really with the collapse of FTX, which kind of rings of back in the 2008 point, this about this exact point in that bear market and Lehman Brothers, Bear Stearns, and all that other similar stuff. Now, obviously, FTX is not on the scale of a Bear Stearns or a Lehman, but it can be the straw that breaks the camel's back here. So I'll get to crypto in 1 second, show you what I'm watching. Near term, I just continue to be in active trader mode and come. This is a 10-minute chart of ES. I've just been going long short lately. Came into the day short, just covered those shorts right before this video started, and that's waiting to hit this. And going to give them a little bounce here. These 10-minute charts work pretty well for active trading, and when you're in a market that's most likely to grind around for a while. We could easily grind around for the rest of the year. Now look, a shoe can drop to the downside. We could have some catalyst that spurs to the upside, but I really doubt that. We've got the Fed coming up on the 12th and 13th. I think the upside, based on how much we've come up the bottom, is very limited. And I think at this point in time, the risk reward is skewed to the downside. So as far as swing positions, I'd favor being short in trend and swing positions, a mild short exposure into the Fed, despite the cheerleading parade on pretty much on mainstream media about seasonality and bullish. They come out of the woodwork after you get a 10% rally. Where were they 10% ago in the S&P or in the beginning of the year? That's all you have to do is look back and see what those same folks were saying, where the market was going in January 1st of the year. Very few of them figured it would go down here. So this is where what I'm looking at. You have a little, previous reaction low right here. We just fell to that. This is a 10-minute chart of ES, and then you have that downtrend line right there. So you have a dual level, and you probably get a little pop here, a little lift in today, a back test this trend line, come up to that 39.62, and then boom, that may be my last trade for the day. In fact, after this video, I may just shut down, walk away with an OCO order. OCOs are to me the probably the best things in sliced bread when it comes to trading. For both those, for the reasons I just stated, I can walk away, go long here with a stop right here and a sell limit order right under that resistance level, and one of the two is going to get hit. Whenever the first one gets hit, if they stop me out, then it cancels that order for me, and I don't have to worry about that order being filled later on. If that target gets hit, then this one gets canceled out. So and not only is it good for those that don't want to sit in front of the computer all day, you can do that with swing trading, you can do it with trend trading. But what it also gives, and where I, from my experience and both myself over the years, especially as an early on trader, cutting my teeth on this, learning how to trade and the psychological component, second guessing a position, and because quite often I will use mental stops. I don't always use physical stops, hard stops like the OCOs, but if I'm going to walk away from the desk, most certainly. And where I'm going with that is the discipline. That's where, and I think some traders, maybe some that have been doing this for many years, lack. And at times, I'll admit, I'm not perfect. We're all human. And by using OCOs, you have a trading plan. You say, I'm going to buy XYZ right here. If it goes below this level, I'm going to stop out. And if it gets up here, I'm going to take profits. That's a trading plan. An OCO gives you that discipline where you don't have to then use mental stops. So if it gets to there, oh, you know what, I think we might bounce. And then you go there and you're still in the position. OCOs don't allow for that unless you pull them. So that's that. Let me see if there's anything to show you on the 5-minute chart. That's ES, by the way. I'm trading NQ. I should have made that clear. This is ES right here, and RTY, but I covered my RTY short as well. Came into the day short those two. There's that previous low right there. Little bit of support below. So, you know, for ES, that's 39.40 is where the little bit about comparable support just below there. And then on NQ, I'll show you that real quick. 5-minute chart right here. You've got support right about here. You have that previous reaction low. We've slightly undercut it. That's normal. And then you have what I like to see on this 5-minute chart, positive divergence. So that's what prompted me to cover shorts and reverse to a long there. For a bounce, it's going to go most likely up to, I think we'll probably come back quite possibly up to this level right here. So that's pretty good resistance. That's 11,705, and you know, if I'm around, I can ride it. But if I walk away, that's where I'll have my OCOs set, you know, to stop out or take profits. And there's a little downtrend line that might spark some buying if we get that taken out. And you can see here I have also multiple downtrend lines. Let me extend this one. I had this one right here from before, and that's the one we're back testing right now. They both come off the high. There's two of them right there. And that's what you usually get in a grindy market. See, when the market starts chopping around, you just get these short-term swing trades. And, you know, we've been walking our way down lately. My goodness, I can't grab my arrow tool. That's what I'm trying to do. But you get these little blips, these little, you know, like an EKG. And, you know, that's again for it's going to frustrate swing traders, but it's you know, a playground for active traders, day traders, and the likes. All right, let's move on to what's more relevant for most swing traders here. 3-month chart, 60-minute candles. You have, I'm not crazy about it, but it's a trend line that I have here. You have this uptrend line. I'm not crazy about it because you only have the initial reaction down here, one there, and then you came through it. What I do know, and what I did point out, we have, you know, we're coming off the most recent divergent high right there, and we've had a pretty healthy pullback, and there's quite a bit of support. When you look at this 60-minute chart here, you've got reaction highs there, you have reaction highs there. You had some, you know, a pullback to that level there. So there's not a hard support level, but again, probably about all we're going to get for right now into today is my guess, and we'll pick this up next week. You know, if I take anything home over the weekend, oh, I can't tell you now, but it would probably be a very mild short position. And if I happen to go home long for whatever reason, I'll let you know. If I come back to my desk, then I would, at most, it'd be a you know, mild long position. But we'll see what happens between now and the end of the day. ES, that's NQ, by the way, 60-minute chart. Let me go to ES, and then we'll get to a few other things I want to point out for you. Started with ES on the short-term time frame, but here's the hourly chart. Again, this is the big thing right here. The primary downtrend lines off the October highs, which we took out, and that was bullish. But then we got ahead of ourselves. We put in a divergent high at resistance, and so far we've corrected. And there's a comparable trend line to the one I showed you on NQ. Let me zoom in a little tighter, and you can see it. So ES, you know, is really the market. A lot of traders trade the S&P 500, and so that's what you're looking at here. S&P 500 futures. Here's your trend line. Comes off this reaction low, and we're right on it now. In fact, I need to tweak it just a bit to come in and capture these lows right here and where we just hit. So that's it. So, you know, not only is it that pullback of everything I just showed you on the 5-minute chart, but here on this more significant 60-minute chart, you've just pulled back to the primary uptrend line off the lows from about November 10th right there, right before the market rocketed up on the softer than expected CPI numbers, cooler than expected. You had you know, support shelf there. We broke it, then we regained it. We're back on. We're kind of slicing through it, and almost seems a little like a complex head and shoulders pattern, you know, with two shoulders on each side. But those are topping patterns that come after a prolonged uptrend. So I don't put too much stock into that, but I just look at the support level there and this trend line. So that's that. Still very much open to the possibility that we may come all the way back down and test these back test these trend lines off the lows from I'm sorry, off the October 15th highs, and then you have this uptrend line which would come in as well. So That is, if I had to lay a hard, I'm not laying a hard bet, but if I have to bet, and I may take a little, like I said, a little shorts home, we could see that next week come down there, and one of the catalysts to kind of go against everybody else, the majority telling you to, be long right now, seasonality and all that good stuff, Santa rally. The flip side may be some profit taking nervousness in front of the next FOMC meeting. So we'll see. It could go the other way, if the market, so far they wanted to believe just because we had one slightly below expectation CPI print that all of a sudden the Fed was going to do some crazy, 180 pivot. I think it's widely acknowledged, and I would agree that they're, not going to keep raising 75 basis points forever. So they'll probably, give what they're going to give and talk about sitting back maybe and watching and waiting, or slowing the rate of increases down, or who knows what, who knows what Powell is going to say. All I can tell you is what the charts say, and right now, kind of near term, probably a bounce today from where we're at starting the video, and then next week maybe a good chance of a downside. But here, let's get to what's most important. All right, I'm not going to go into the sectors because I covered those yesterday in detail. Just to kind of recap it for you right now, of the 11 sectors in the S&P 500, 4 are trading red. My favorite, which has been for about a week or two now, favorite short is XLE. Like I said, the most bullish sector chart-wise in the last few weeks has been tech, and then the most bearish, even though it's at all-time highs. Remember, I don't trend chase. I try to trend predict, and so yes, this is has been and would still be by most metrics considered the most bullish sector out there because we're just off. We're only a few days off the all-time highs, but to me, it's a sector that's rolling over, put in that big divergent high, and I got some charts out to you this morning. I did finally get the ERY chart right after that post came out to you by email. I uploaded the ERY chart. I just added some potential targets. And what I was saying on there, hopefully it makes sense. This is the main sector ETF. ERY is 2-time leverage short, so it's going to have some decay over time. The leverage can work for you if it's a pretty swift move down. Then you'll actually, in that case, with very little kickback rallies, especially closing candles. That's all that matters, not intraday. It's how it closes. The more red closes you get, the more that 200% leverage can actually work in your advantage. And what I mean by that is, should XLE, let's just say hypothetically that we go on and hit my third target down here at about 75, 77. That's a 16% drop. Very possible you can see ERY, instead of doing 32%, 2 times 16, you can see it do 40% or more. It depends on the fashion. So the optimal scenario would be a bunch of mostly red candles with very few green candles in between till you get down there. What the decay, and I explained why this works this way. If you grind around, chop around, it takes a while to get there. That's what tends to give you what they call the decay on the leverage ETFs, where you might get less than twice the drop in XLE. And again, that's assuming that T3 is hit. And again, if you want to read up on how and why that works, just click on resources on the top menu of the site, and then go to the Sports Center here, FAQ, frequently asked questions, and then you can sort those questions by ETF related questions only right here, the topics, or you can see them all. And this one right here, what is the advantage, or is there a disadvantage to holding a leveraged ETF for an extended period of time? And the math on how it works is right here, and again, right down here. So it also shows you that in some cases you can actually do better, and I've gone over that many times in the past, where we position for what I think to be in a pretty explosive rally, gold mining stocks, things like that, and we get it, and we actually then do better. So just to go back to that chart, so and what I also said there is that's why you want to, the one time, in other words, XLE doesn't have the decay, so you want to maybe align your targets there. So let's say we get up here, because you can see T1 about 33.68 is on ERY. You have these two reaction lows right there, but then when you go to XLE, it doesn't look exactly the same. You have, the over time there's been some decay, so that's why, like I said, you want to look at. It's this reaction here, right there, is late August, and then this one is early October, and maybe that is close enough. ERY. Yeah, late August. There it is. Early October. So it's close enough, but this one's a little higher in ERY, and that's again because you're going to have that decay sometimes. But all right, enough on that. We'll see. It either works out or doesn't. That's the thing. Sometimes I sit and talk about a trade over and over, day after day. And like I say, at the end of the day, you don't put all your eggs in one basket. Some of these trades work out. Some work out great. Some don't work out at all. So you take some. Put your stops where based on where your entry is, average entry price. Most people, or I like to scale into, trend and swing positions, meaning take different lots at different times, and therefore, my cost basis is going to be different from yours. That's why I got away from doing the, suggested stops that I used to do years ago. It just got too complex with multiple entries that I would highlight on all these, pullbacks to support and all that stuff. Oh yeah, before I get away from that, let me just give you an update on crude and natural gas, especially crude. This is a daily chart of CL crude futures. We've taken out, there's pretty good support here at about 80.64. We dipped below it once, recovered, but now we're below it again. And of course, as I pointed out recently, we took out this, we had a triangle pattern in crude and we broke down. And so this to me has not been reflected. Here we go, right here for an example. Here's where crude topped all the way back in June. Crude's much lower, and yet XLE, the energy sector, which is top heavy, and the charts mirror each other, ExxonMobil, Chevron, ConocoPhillips, all that. Those guys are right off all-time highs. So I think there's a game of catch-up to the downside to be played there. And then you can look at nat gas as well, which is well off its highs. UNG, it's a good trading vehicle. I've been trading this in and out, but most of these are very short-term. I'm not even posting most of the setups in nat gas. It's just, it's such an active trading vehicle right now, like the markets, that it's, you almost have to. You can't follow. In other words, a lot of these, this is a 10-minute chart right here, you can see, and you can see all these trend lines and trend line breaks, triggering sell signals, trying to get a line tool, little, you get divergent lows, you look for those, you look for these trend line breaks, clean up trend lines. Again, nat gas, it's not going anywhere. I just showed you that on the daily chart of UNG, but if you're an active trader and you trade off these, 10-minute charts, look for divergent lows and divergent highs, and look for either buy a divergent low at support or buy the breakout. If I added a downtrend line there was a breakout right there, and so you can game these little micro squiggles, and they're worth it. When I say micro, it's not too small. This is this line right here shows you that's about a 9% move. And so most of these little trends are, you're going to get anywhere from 5 to 10% when you're locked in a trading range like this. And then this is what it looks like. Bigger picture, you go out 3 months, and you've got this uptrend line. This was the last official trade I threw out here, breakout on that one. And we hit that first and second target up there. But since then, it's just been a good trading vehicle. You can buy pullbacks to the trend line. It's almost forming a triangle, like an ascending triangle pattern here. So it could pop, but if it breaks to the downside, that's going to put further pressure on the energy stocks. And like I said, crude is looking pretty bearish. And enough on that. All right, so you know where the targets are on XLE, and sometimes it can do its own thing, but for the most part, it's going to follow crude oil most importantly, and natural gas to an extent, because a lot of those companies are also selling natural gas, but most of big energy XLE, they're going to track crude oil more so. Okay, let's talk crypto. I've been reading up a lot on crypto. I've been searching for things I'm looking for. One of those, and I don't want to be all over the place here, but you know me, I think one of the biggest shoes to drop, one of the biggest problems going forward will be underfunded pension funds, public pension funds, and I've looked in to find out how much exposure they have. and they don't even know. There are a lot of them, CalPERS and some of the likes, are looking into this now, because some will tell you exactly, well, we have this much in Bitcoin, and usually those that I find do have direct exposure to cryptocurrencies like Ether or Bitcoin. It's a relatively small amount. However, their problem, and they don't even know, and a lot of them are trying to look into this now, there's a lot of indirect crypto proxies. Some of those, I'm going to go over the charts here in a second. We've traded them for years. Things like Coinbase. Coinbase is another big exchange. Companies like, let's see, we have Mara Digital Holdings, Overstock.com. Those are some I've used as what I call crypto proxies, Riot, blockchain. And so what I'm finding out is, yes, and I've said this, that Wall Street has their arm shoved way down the cookie jar. They didn't just get caught with their hand in there. There's a lot of exposure, and I think most of it's still unknown. And I know that by looking into this. These hedge funds are trying to find out what they own. Here's why: because they have, for example, they have some of these indirect crypto proxies, like I just mentioned. They might not be crypto coins or currencies they're holding, but they're companies that derive a good part of their revenue, some or all of it, from that whole arena, whether it's from mining operations, crypto mining, or blockchain technologies. And then what makes it even worse is the hedge funds have been piling into private equity for years, which again is the next shoe to drop in my opinion. Private equity gets to kind of mark their own assets to market what they figure it's worth, and there's a lot of talks out there that they've, and I have very little doubt that they have not fully marked down the value of a lot of their assets to reflect when you just look at what the stock market, not just what the stock market did. You might say, well, okay, maybe this private equity firm is in all kinds of businesses or other things that aren't correlated to the stock market. No, we know since the beginning of the year just about everything with a ticker fell. Most asset classes fell, bonds fell. And so I believe that once that comes out, you're going to see a lot of markdowns on the private equity portion of where many of the pension funds have shifted a lot of their money to away from publicly traded securities, i.e. stocks and bonds. And then on that, that's the part they don't know about. In private equity, a lot of those private equity firms and funds that they put money into, they may have a bigger exposure to crypto than they think. So anyway, it's a potential time bomb for the market, and maybe not. There's been a lot of things I myself and others have warned about over the years that never came to fruition, but it is something worth monitoring. And then this is Bitcoin. Bitcoin's still the biggest by far, especially with exposure when pension funds and in just all institutional investors in general. Ethereum's getting up there, but this is the big one. This is the level right here. Again, my point is that we've been here for a while. I've been covering this. We've been trading. I'm going to zoom in 6 months. Bitcoin right here is under massive support, 18,329, and as long as it remains there, it's in a bearish technical posture below big support that it just broke, and it's a very precarious position. And I suspect there'll be another leg to come. But if we start recovering and we get solidly above that level, as long as it sticks and it's not a little fake out, that would be bullish. So bullish above there, bearish below there. We're below there now. And so therefore, I'm going to rifle through a lot of the other my crypto holdings. I have a watch list. And now, again, these are all companies. Some of them are direct, some are indirect, like Coinbase, big crypto exchange. And I'm just showing you very quickly a visual where they're at. So I'm going to tell you the glass half full, glass half empty. Glass half empty, they're in big downtrends. For example, here's Coinbase. It came public back here April of last year, spiked to a high that day, and the stock has fallen 90%. So let me try to put this in perspective for you. And I know this is one, for example, that quite a few of the big pension funds hold. This holding. Now they disclose the number of shares, but not really where their cost was. You can just make a safe assumption. A lot of them probably bought on or around the IPO, or even if you go in the midpoint here, just take a midpoint on this chart and then pull down, and I'm measuring down, and it's telling me that that's down still about 63%. The thing that a lot of investors fail to grasp, and the reason why Warren Buffett said rule number one to investing is don't lose money. Rule number two, never forget rule number one. All right, something like that. because what a lot of investors may not realize until you actually experience this, when you lose, the way math works, it's very cruel against you on losses. When you lose 50% on a stock, any position, at that point, the stock doesn't have to go up 50% for you to break even. It has to go up 100%. It has to double, because when you lose half of something, then you need to double to get back to where you were. And the farther you go down, the higher that relationship gets. So for example, if you look at my pop-up box to the left, again, here's Coinbase. And Coinbase down about 90% from the highs, right, to the recent lows, which is the same where it was here. It's a big support, by the way. It would now have to rally from here, so all I have to do is grab that same point and measure up to this point, and the pop-up box to the left tells me you'd have to rally this stock. Instead of rallying 90% to get back to where it is, it has to rally about 900%. It has to go up ninefold. It's possible, sure, anything's possible, but it's unlikely. And so these are losses that are probably going to be there for a long time, and it could certainly get worse. Now the glass half full, see what I just did? That's positive divergence. We're making equal lows, 1, 2, 3, potential triple bottom, and here's the thing: it's a downtrend line. So if the sector shapes up, or this particular company shapes up, maybe Coinbase will be the beneficiary of the failure of FTX. I'm throwing out not so much a trade idea. Me personally, I'm probably one of the most aggressive traders you'll know, but I'm kind of standing aside this right now. I'm not. I'm going to let the dust settle. I'm going to let this sector see which way it goes. I suspect the bottom could fall out here, but just as well, I've seen many a stock or the stock market itself just staring over the abyss, down into the abyss right on the edge, only to see it rally from there. So it's possible, but if it breaks down and then you see these divergences start to go, because in a bear market divergences often don't play out, or they don't play out at all and they get taken out. So I just wanted to show you, and this is going to be the common theme. You're going to see a lot of these stocks or crypto proxies way down. EBON, same thing. You can draw the lines. A lot of them, they're way down from where they were. EBON, eBang International Holdings, I can't remember. I think they might be a minor. Down almost 100%. So they're pretty much gone. They're already 27 cents a share. Usually it's good night when you get down below a penny a share. So it's got the divergences, but it had divergences here. And it just keeps going down. So a lot of these are going to the wayside, and this is going to have, again, because it's not just the meme crowd, those Reddit groups, and when everybody, when COVID hit, nobody was working, everyone was staying at home, the government was giving people money to sit on their ass at home, giving people checks, extended unemployment, and outright $1,200 or whatever they were cash checks. We know for a fact that Robinhood and all these little online brokerage exploded in popularity, and you had everyone thinking they were geniuses, beating the hedge funds, trading meme stocks and crypto. And now we know what's happened. We can see again big losses in crypto, and in a super risk-on environment, which the Fed created with excessive easy money policies and federal stimulus from DC as well. That's what happens. This one's down 93%. It's at $2 a share now almost. Again, across the board. I just want to point this out because I don't want to be Debbie Downer here showing you all the negatives. This one didn't break down. In fact, it's at great support right now. I can make a bang-up case. I'm not doing it because of fundamental. I think the risks are too big. But if the sector stabilizes, I might not nail the bottom. The bottom would probably be right here. And this is it. This is what I'm trying to say. These stocks, and it's not coincidence, I'm going through a lot, are at do or die levels. They're all at these key support, not all of them, but most of them at big key support levels. This one put in a double top high and never looked back. Then it took out the trend line. Then it took out this support level, back tested it, and now it's at really, really good support. If it breaks that, there's not a lot of support on the way down. There's some levels and lines I can draw, but then the stock's going to enter penny stockville soon when it goes below $1, and so that's it. So I think this sector is going to go either one way or the other soon. The fallout from FTX is either going to have ripple effects that will permeate and then create a vicious cycle of selling and other collapses. And look, if you want to look at it from a fundamental perspective, the best case scenario, we know that the regulation's coming down the pike this time around. After FTX, the SEC looks like a fool. Even the current administration, they're going to be blamed for it. I'm sure. Haven't really looked into that yet, but I'm sure the Republicans are going to blame the Democratic administration for allowing this to happen under their watch. So you're going to have political pressures, and so I think at best case scenario, if these crypto exchanges and the likes are going to survive, the regulation that they've been trying to really get going for a while is coming, and then regulation is onerous. It's and expensive. There's a lot. It would be maybe a long-term benefit, but probably a short-term negative. Due to the expenses and costs and everything involved. So I struggle to find a positive catalyst fundamentally right now for crypto. So, but we'll see. Again, the charts are there, so maybe we're going to rally. And sometimes it does this. Sometimes even if they're these companies, a lot of these are going to zero. Maybe they break out and the technicals rule, and then you rally all the way up here, and then you go down. That could easily be a possibility. I'm just showing you levels, and the takeaway is, I know I'm talking fast and throwing a lot of stuff out here. Just set alerts, and if you have alerts, or just watch these replicate, especially some of the bigger, more important ones like Coinbase and the likes. And then if you see one after another breaking down, that's bad. If you see one after another breaking out, holding support, or maybe a false breakdown and a recovery, and then they go on to break out trend lines, well, that's bullish, and then you might want to engage the sector. Even if you don't believe in it, you can buy it and then have stops in place in case it is a false breakout. But right now, again, I'm watching this more to see what the implications on the market. CIFR, Cipher Mining, now a penny stock, 89 cents a share. Yeah, it has positive divergences, and it broke out and has been back testing this downtrend line with bullish divergence, but it had positive divergence here, and so far and it had positive divergence right here as well. So there's an example where sometimes these bullish divergences are just the steps on an escalator down to zero. That's what it seems to be so far for a lot of these companies, and so I would be remiss and ignore bullish divergences at your own risk, because even though this was a bear market rally off this last divergent low, that was a 105% rally. If you were short the stock and you didn't get squeezed out, well, you've got a pretty iron stomach there, but most people would have been squeezed out. So that's CIFR, BITF, Bitfarm, same thing, divergences, but heading to zero. It's down. It's at 67 cents, so penny stockville. At the highs, people were buying this stock up at $9 a share. It's down 93%. You lost almost all your money. And if you're in this one, the chances of you getting your money back if you bought up here is not zero, but it's pretty darn close. Chances are when a company has this trajectory and heads down here, you're looking at delisting notices and all this stuff, and then it's just a downward spiral. Marathon Digital Holdings. There was a bullish falling wedge right here, a little breakout, and I might have highlighted that one because this line was, when did I do that? That was on back in July. Yeah, I created that line, or August 1st. And so it popped, but then boom, it's already fading. That rally got rejected. The 200-day moving averages. See these 200s? A lot of stocks like these 200s, the red and the blue line. It was resistance. You broke out above there. Boom, that's a buy signal. And then you buy every pullback to the 200s until they break, and that's when we break. So we were above. We took out the 200s there, and we were above, and then we broke this stock, broke down below, back tested them from there. So if you missed that short entry, you shorted it there. And then if you missed it, you shorted the 200 right there, the push back to the 200 exponential, and then you hit it again there. And so this is a stock, the takeaway is it's in a downtrend. It's below its 200-day moving averages. Now, whether it's a week from now or 3 months from now, if it takes out the 200s with conviction, then hey, maybe there's something else going on, and then that's the time to be long the cryptos and the again, the crypto proxies, as I like to call it. I think I already covered Hive blockchain. This is the .v. If you see .v on my charts, it just means the Toronto Venture Exchange. So the TSX is the big exchange there, and the Venture Exchange are your higher risk stocks. It's kind of like our NASDAQ 100 or our small cap index. These are smaller, more speculative companies on the Canadian Toronto Venture Exchange, and so that's just the version. There's Riot blockchain. This is a big one here. We've traded this one many times over the years, long and short. And oh man, I can't find my right tools here. Here we go. Nice uptrend line right there, and big support about 428. So this one, like all of them, it's sitting at a key technical juncture. Bitcoin's already broken down and now needs to recover, and if it doesn't and Bitcoin starts to take another leg down, which is what I suspect, that would be the catalyst. And again, don't underestimate just how powerful or potentially powerful the ripple effects can be of a further collapse in the crypto industry, because again, it's not just those crypto. You might say, Randy, I've never bought crypto in my life, my 401k doesn't own it. It doesn't matter, because even if there's the mutual funds in your 401k don't have any, if the market goes down because a financial institution fails, or a big there's a problem with the pension fund industry or something along those lines, it could have ripple effects throughout the financial system. And so these are the things I'm watching. And there's Bitcoin Trust. This was one of the first to market, and I know this one I read is in quite a few pension funds bought direct exposure to Bitcoin through GBTC, which is that it's similar to an ETF, and it tracks the price of Bitcoin, and it's got nice positive divergence. We bought it before. We bought it last time. We bought it here. I have a million notes on this because I've traded it long and short so many times, and I was trading Bitcoin with impunity back here with these shorts, short entry, sell signal, short target, 1 hit, 2 hit, 3 hit, posted as a reversal there to go from long to short, hit first target, second target, then shorted it here, 1, 2, 3 short targets hit, shorted it again up here. So the setup is there, and normally I might be stepping in here, but as I told you, I'd rather miss the turn on this one and be more confident than be in here long, go home over the weekend and then wake up Monday morning to some huge crash in crypto, and experience a big gap down that I can't control or mitigate those risks with a stop loss order, because I'll trade Bitcoin futures if I'm not trading any of these individual crypto proxies. All right, I can go through them all. MicroStrategy, this is a big one to watch. And you can see I don't have it all marked up for you, but it's got an uptrend line right here going back for the last couple years that it's flirting with, and it's in a downtrend like everything else in the sector. CME, they've got their hand in the cookie jar a little bit, so that's why I have them in this group. I think the crypto or Bitcoin and Ethereum futures trade on the CME. There's your little pattern right there. ETCG, this is the Ethereum, Grayscale Ethereum Trust, the first to market, the first generation of Ethereum, and then you have ETHE, I think I might have already covered. XBTF, this is here's an ETF that was rolled out, one of the later ones. VanEck Bitcoin Strategy ETF. So imagine the poor folks that bought this thing at 60 and now it's trading at 16. Looks to me, again, if I just eyeballing this chart real quick, looks to me like a potential bearish pennant right here after this big impulsive leg down. It's also back testing the trend line there. And it also has, like most of the other things in the sector, some positive divergence. Pretty good positive divergence too. But so if you're a crypto bull, I'm showing you some of the charts that look better than others. You could certainly take positions with stops somewhat below, and they might pay off well. Who knows? I don't know. But I'm going to watch this, and I'm going to may engage this sector at some point in time, or also watching it for potential problems in the market. That's why I'm going over this here. BITO, that's the ProShares Bitcoin Strategy ETF. CBOE, other ones, it's got some relationship to them. That's right there. Recently hit that trend line after putting in a divergent high. So in CBOE, which is one of the big exchanges, you want to watch for a break of that 115.56 support right there. That's another one, very thinly traded. SDIG. Just see a lot of these guys are just headed down to zero. They'll be gone soon. And maybe that's a good thing. Maybe the industry needs a little washout, a little consolidation. There's some divergence, but again, the stock's already down to 80 cents a share. And keep in mind, the lower price ones, if there is a big rally in the sector and Bitcoin and Ether rally next week, then yeah, they'll probably, you'll see the lower price ones often tend to pop more. Not necessarily, but typically, generally, the lower price stocks tend to rally more so. BTF, another Valkyrie Bitcoin Strategy ETF. And look at it. This is also a sign of the times. Crypto is just like the the .com bubble. They're different things. Yeah, those were stocks. With many of them with no value, and that's the similarities. And then, but you see the popularity. Look at how many ETFs I've already gone off over 3 of them that came to market just within the last year or so. And these poor suckers. I mean, just nothing but straight down ever since it came public right here back in late 2021. Alright, sorry, I just stopped the video. I figured since I'm still going, I just wanted out. I told you I might be shooting for a move up here on the NQ reverse from short to long here at the bottom. But this is resistance. We'll probably get a pullback here. You have both the downtrend line and that 11,667. So I just went flat. And I may stay flat. Let me finish the video. I just wanted to apologize for pausing. I go through it, but then I'm beating a dead horse. You get the point. Most of these, and what I'm clicking through and didn't even comment on, some of these have already gone to the wayside. And you see a stock like this one, Global Gaming Technologies, gone, zero, bankrupt. This one's 0.4% First Bitcoin Capital Corp. That one's gone. A lot of these have already gone. There's the NYSE Bitcoin Index. Another ETF, right there, BITI. This one's popping up lately. I don't know. I don't even know what they hold. MoneyGram, Overstock, again, crypto proxy, same thing. A lot of not a direct crypto company, but they've got their hands in there, and positive divergence. So maybe something positive is coming out of the sector soon. We'll watch, and if so, that should help to put a risk-on bid under the stock market. So that's why I do these things. The stock market is just so complex, so many areas, and at some point in time, one area is more important to watch than the others. So the things I'm watching lately are this for the stock market, among other things, and then treasury market, gold, and oil, of course. I think that's a big one. Commodities right now, for 10 years nobody was really talking much about commodities because it really didn't matter, and you could trade them. I had plenty of trades on the site here, but it didn't really matter when soybeans was rallying or natural gas or crude, because we were in a low inflationary environment. Right now, the markets are hypersensitive to rallies in commodities because that's going to force the Fed's hand. So that's an example of why I'm upping my coverage of commodities. So these are some of the big things here. Crypto, for the reasons I mentioned earlier in this video. Crude, natural gas, and even treasury bonds. All right, let me wrap it up here. Video, gosh, it went longer than I thought it would, based on what I covered. But that's it. That's the gist of it. Like I said, today is mostly flattish on the markets. Half the sector's up, half down, roughly, and really go nowhere day. And that was the other takeaway. As I told you in the beginning of the video, it may be that way for a while. We're still, we're grinding around here at the bottom of my, bear market rally target zone, if you will, after kissing it the other day. And I don't know where we go from here next week, so I'll just stay in hit and run mode for now, meaning just trading, gaming, bouncing the futures off the 5 and 10 minute charts with an eye on the 60-minute and daily charts as well. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.